And this is almost, I think, almost our third installment of the topic, Whither the Economy. And that gives you some indication of how bad this whole situation has been when you can go a good year and a half and still be talking about something that we saw very badly towards the end of 2008. So we're going to start things off. I don't have a formal description of our distinguished speakers with me, but I'll suffice it to say our first speaker, Professor Hiro Ito from our economics department. And maybe I'll just let Hiro do an introduction for himself. Please welcome Hiro Ito.
Well, thank you very much for coming. This is Hiro Ito. I'm Associate Professor of Economics. And yes, I organized this event back in 2008, 1 month after the collapse of Lehman Brothers. And honestly, I didn't think that I'll be organizing the same kind of event in 2011. So, as Tom said, that really indicates how the problem has been around for such a long time. So, what three of us decided to do is to have, I'm going to start with presenting a really big picture of what's going on. So, I'm going to take a really first view of what's happening in the,
I wanted to see you see it.
Do you want this clicker to
go
over and reorganize
Well, thank you very much. So I'm going to start with providing a first view of what's really going on and how everything is going on in terms of the world financial crisis and what kind of environment the U.S. is facing. Then we're going to continue to shrink the picture. So the second speaker, Tom, he's going to talk about the implication of the current crisis on the Oregonian economy, and Mary is going to focus on the situation by talking about the socio-economic impact of the crisis. So as I said, my topic is the current situation of the world economy and its implications for the U.S. economy. But I'm going to spend most of the time talking about Europe. I must admit that I'm not a European expert. I usually focus on the Asian economies, but I do focus on international macroeconomic situation. And I must say the current situation in Europe is academically interesting, but of course for people living there, it's not an interesting issue at all. But in any case, I'm going to focus on the euro debt crisis. The reason why is quite simple, because that's where the crisis is taking place right now. And also the second reason for that is because there are some aspects of the crisis in Europe that are similar to what the US is experiencing right now. So there has to be some educational lessons we can learn by looking at the situation of the European region. And lastly, if we think about the short-term prospect of the US economy, the situation in Europe is really crucial. So depending on how the European region goes through this crisis period, and that's going to really determine how the U.S. economy is going to be performing in the short run. So in that sense also, it's very important to start taking a look at the European situation. So we all know that the European or the euro area is experiencing the euro debt crisis. It started with the readdressing of the budget by the Greek government. So what happened is that they fabricated the size of the budget deficit in 2009, and that was revealed by the newly created government in 2009. So initially they reported that the size of the budget deficit is around 3% as a ratio to the size of the economy, which we measure using GDP. But the real size of the deficit was about 13%, negative 13% of GDP, which is much, much bigger than many expected. So that was quite a shock. And of course, that shock was followed by the downgrading of the government debt and also a series of austerity plans, meaning that the government needs to restrict its spending and raise taxes and lay off bureaucrats so that they can shrink the size of the budget deficit. And also they can convince the markets that the country is willing to pay off the debt. But people in Greece couldn't stop the crisis. So the crisis spread to other economies, such as Ireland and Portugal. Ireland had a financial boom before 2008. Then it went bust because of the crisis that happened on a global scale. And consequently, the government tried to bail out many banks. So the result was a mushrooming budget deficit and national debt. And Portugal has the history of having relatively high level of debt for a long time. So it was very vulnerable to stop this. And it is also sort of famous for having unstable politics. So these two countries are the easiest targets for what economists call contagion. So these economies got also affected, and all three economies, Greece, Ireland, and Portugal, requested and received rescue funds from both the European Central Bank and the IMF, International Monetary Fund. And soon after they received the rescue funds, the situation seems to have started looking more stable in 2010. But the situation in Greece didn't really improve. And the political situation got worsened in the beginning of this year. Then the crisis re-emerged in 2011. Then now it started affecting bigger economies such as Italy and Spain, which are third and fourth largest economies in the euro area. Okay. And now bigger economies seems to be in trouble because Italy and Spain also have had relatively high level of national debt for a long time. Then there are some rumors that the next target will be France and Belgium, because these two countries have many financial institutions that have a lot of assets in Greece. Okay? So the European crisis is getting bigger. But the debt crisis is getting bigger in Europe. What does that mean? Well, what that means is that, of course, these economies started with having large budget deficit, and that contributed to an increase in the size of the national debt. And these bars show the size of the budget deficit. And you cannot see the United States, but the US would be, the size of the budget deficit for the US would be somewhere here. So it's even bigger than the size of Greece and Italy in terms of the ratio to GDP. Then you see the size of the national debt. I can show you in the next slide. These economies are experiencing a rapid rise in the size of the national debt. Greece, Italy, Portugal, Ireland, Spain, UK is the same, and here's the United States. Then the rise in the national debt means that you can think of a situation where your credit card bills just keep accumulating, and what are you going to experience? Well, what you're going to experience is a rise in the interest rate you have to pay. So for these economies, the cost of borrowing money is rising. And the right figure shows the additional interest rate these economies have to pay compared to what Germany has to pay. Germany, in that region, is the safest country in terms of economic performance. Then these economies, such as Greece, Portugal, Ireland, and now Italy and Spain, they have to pay extra to borrow money from the markets. So, as I said, what this kind of debt crisis can do to economies is a rise in the borrowing cost, and that's what's happening. And the rise in the borrowing cost is not just for the government, but also for the people as well. Then, in that kind of situation, what the government has to do is to convince the market that the country is willing to pay off the debt eventually. So for that, to convince the market, the government has to implement what we call austerity plans. More specifically, the government has to reduce government spending and raise taxes. But these economies have to implement this kind of policies when the economies are already very sluggish. So these policies can only harm the current situation. Then, so that means that this kind of policy is very unpopular domestically. Okay? And that is one of the obstacles for these economies to overcome the crisis situation. And some of the things I talked about are quite similar to the United States. Rising borrowing costs and the need for austerity plans and so forth. But there are some Euro-specific problems as well. One of them is that these crisis economies have no macroeconomic policies available. Why? Well, it's just because these countries are part of the Euro. So that means that, first of all, their monetary policy is given up to the European Central Bank. So the monetary policy is not available. What about fiscal policy? Well, because of the need for austerity plans, they can't increase government spending, they cannot implement policies that create more jobs or raise income for some people and so forth. No tax cuts are being allowed and so forth. Then, third of all, if a country experiences a downturn, usually the value of the currency declines. Okay? And depreciation of the currency value helps exports to grow because the price of exports will fall. Then the rise in exports can function as a buffer for a recession. But for these economies, well, depreciation will never happen because they don't have their own currencies. Okay? So, economically speaking, they have no monetary policies available. Then, another issue is the political deadlock. Of course, there's a political deadlock in those crisis countries because nobody wants to see the government reducing its spending or increasing taxes and so forth. Those policies are always unpopular. But at the same time, these economies cannot expect it is very hard for these economies to expect other bigger economies to be willing to rescue these small economies. Because taxpayers in those bigger economies, such as Germany and France, they say, why do we have to bail out those countries? Those countries are in trouble just because of their poor macroeconomic management. Why do we have to be responsible for that? So that's the kind of general sentiment prevalent, especially in Germany. So that makes it so difficult for bigger economies to bail out these weaker crisis economies. Then this environment makes it harder for the crisis countries to overcome the current situation. But it doesn't mean that the Euro countries are not doing anything. They created a facility called European Financial Stability Facility, ESFS. This is supposed to provide funds to bail out crisis countries and troubled banks in the area. But the problem is the money available in this facility is not large enough. So if, for example, both Italy and Spain go bust, they don't have enough money to bail out these two economies altogether. Why doesn't this facility not have enough funds to bail out these economies? Well, it's just because other relatively more healthy economies don't want to spend so much money for this facility. Okay? So what that means is that there's a political struggle going on, both inside the crisis countries and between healthy economies and crisis economies. Okay? Then that really creates political deadlock. And political deadlock is what makes this crisis lingering for a long time. But the lingering debt crisis is not a good thing, of course not, because it can lead to banking crisis. Then if banking crisis happens in Europe, that will most likely affect the US economy. Okay. Then that's going to be quite chaotic. But before talking about the US economy, let me talk about how the rest of the world is doing. We all know how the US economy is doing. We have our own debt issue, and unemployment situation doesn't seem to improve. So the short-term prospect of the economy doesn't seem to look good. Then what about Japan, which is the third largest economy? Well, they have to deal with their nuclear crisis, which was caused by the earthquake and tsunami that happened in March. So, they have their own problem. They can't really afford to help out European countries. What about other countries, especially developing countries? Interestingly, developing countries have been relatively doing well. Countries like China, Brazil, and India, these are economies that have been relatively robust despite the financial crisis of 2008. But these economies may be doing too well, meaning that these economies seems to be experiencing overheating of the economy. Then policymakers in these economies are trying to calm down the economy. And a good example is China. China, many say, may be experiencing a financial asset bubble. Then it's very difficult to guide the economy to have a soft landing if there's a bubble. Then maybe that's the situation where the Chinese economy is. But overall, what we can say here is that developing countries also have to slow down. Okay? So you can see how global the situation, the current situation is. Then let me talk about the situation of the United States. One question many people may come up with is that, is the situation of the United States, is it the same as the situation Greece is facing right now? Well, the answer is clearly no. Well, we have a rising debt issue, the short-term prospect doesn't look good at all, but we have a very strong privilege, which we call exorbitant privilege. So what that means is that the US is the issuer of the dollar, meaning that even if the national debt size rises for the United States, the US can print money to pay off the debt. Then, at the same time, whenever there's some kind of global scale crisis happening in the world, it is interesting to see that the dollar appreciates. Usually, economic downturn led the currency value to depreciate. But US dollar is one of the few currencies that appreciates in the middle of a crisis. Why? Because people try to hold on to US dollar assets if there's economic uncertainty or downturn. Okay? So what that means is that the rest of the world is willing to buy US government debt if a crisis happens. And that's the privilege the US enjoys. What about other countries? Do other countries have this kind of privilege? The answer is no. Well, 5-6 years ago, some economists are saying that the euro is going to replace the US dollar in terms of the international reserve currency. We know what's going on in terms of the euro. What about the third largest currency, Japanese yen or British pound? Both economies are also suffering as well. So, sort of through the process of elimination, it is the US dollar people try to hold on to if the crisis occurs. And ironically, that gives the power for the US to convince people to buy American government debt. Okay. So US, in that sense, is in a better situation. But it does not mean that we are not facing any risk. As far as I can think of, there are two biggest risks I can think of. One of them is the contagion. Well, if Europe experiences a crisis, that's going to come to New York and that's going to affect the rest of the US. Why? Because American financial institutions hold European government debts, or European financial institutions hold some of the American company stocks or some municipal bonds and so forth. So if something happens in Europe, that can come to America. Okay. And the second risk is that there's a general atmosphere in the United States that seems to prefer short-term austerity plans. Okay. The famous argument would be the Tea Party argument. They prefer to have the U.S. to have the amendment to the Constitution to balance the budget. Okay. So their idea is that the U.S. having a huge budget deficit is such a bad idea, it's such a bad thing. So the U.S. needs to reduce government spending and maybe raise taxes. But very few people prefer rising the taxes. But the main point is that people seem to prefer the U.S. government reducing government spending. Okay? But if that kind of short-term austerity plans are implemented in this country, that's going to kill the economic recovery. Okay? So that's the second risk the U.S. seems to be facing. So what should we do? Well, in terms of economics, I think more stimulus is needed. Okay? We all know that the debt for the United States is rising. We all know that we have a really large budget deficit, but for the short term, we need stimulus. So that means that we need to implement Mr. Obama's job creation plans. Then, at the same time, the government needs to present some sort of a medium-run plans to fix the public finance. So what that means is that maybe fixing the loopholes in taxes or maybe considering some reduction in social benefits can be a good idea in the medium run. Otherwise, the markets won't continue to keep lending us. Okay. Then the third issue is the political issue, and that's what I want to stress, and that's what I'm going to talk as the last point. That is that the U.S. does need to avoid what I call political recession. What does that mean? Well, political recession means that political deadlock makes it harder for policymakers to implement appropriate policies at appropriate timings. And the reason why I say so is because of the experience of my country, which is Japan. Japan experienced a financial bubble in the 1980s, and it busted in the beginning of the 1990s. And since then, this economy has been experiencing recession for 20 years, probably the longest recession in modern human history. Okay. Then, while the economy is experiencing a long recession, the size of the debt is now 220% of GDP, which is the way highest amount. Okay. Well, because the government tried to stimulate the economy by creating a lot of public works spending programs, or giving a lot of tax cuts and so forth. Some of them are effective, but not effective enough to let the economy jumpstart itself. Okay. Then the Bank of Japan lowered the interest rate to zero in 1999. So it's been 12 years since the Bank of Japan implemented the zero interest rate policy, and still the economy is not recovering. Why is this the case? I say that's mainly because of political deadlock. Again, politicians are so busy trying to gain something for their own parties and so forth. I'm talking about Japan in this case. But that made it so difficult for politicians to implement appropriate policies at appropriate timings. And while the government was sort of lagging in terms of implementing appropriate policies, people lost their trust in the government, and younger people cannot really picture nice future for themselves. So people became very pessimistic and cynical and indifferent in what's going on in terms of policy making and so forth. So I say political problem is the main reason for this economy to suffer. Then my point here is that the U.S. has the risk of experiencing the same thing. Okay, so that's the last message I want to convey. So to avoid that to happen, I think we need to have appropriate discussions, and for that we need to have information. Then probably this is a good time to pass the mic to Tom. And so this is it for my presentation. Thank you very much.
Okay, so what we're going to move to is looking at, now you have a good picture of the European problems, the problems that are impinging upon the U.S. economy, and then what I will do is take that same aspect of the U.S. economy and how that may impinge on us here in Oregon for our economy. So, I've got to go to the next. All right, so if you remember the children's book about the little train that could, we're all hoping that this recovery is also going to be able to make it. Because right now, if you watch the news, there's a lot of talk about the possibility of a double dip, where we fall back into recession. Now, supposedly, the recession ended in, let's see, that would be June of 2009. It may not feel much like it that it ended, but that's our National Bureau of Economic Research designates that as the ending date. And the fear is that, we've got a very slow patch right now going on. We've got a lot of headwinds that Professor Ito described. Is it possible we may go back in recession? So I'll talk a little bit about that. whether the little train's going to be able to go up the hill, or is it going to come back down the hill. And unfortunately, the probabilities right now are, most economists are looking at about a 40% chance of possibly falling back into recession. What you want to say, it's basically a stability item. You have something that's on a platform, let's say, it's very steady. Well, we still think that is the route that the economy is going to take, but it's now out over the edge a little bit. And anything can kind of push it off. So rather than only being 10% over the edge as a risk of going into recession, now it's like 40% over the edge. And so I think most of the profession believes that, although if you want to get your name in the paper, then you start to say there will be a recession. It's always a good way to get your client up and make more money as a consultant, to be against the grain. We're not alone in this. We have a lot of other states that have run into problems. This shows from the Philadelphia Federal Reserve State Coincident Index. You can see that when it's all green or dark green, nice and lush, that's good. That's growth that's happening across all the states. And that was taken in April of this year. And in fact, if I looked at up to January of 2011, you'd see even more dark green across all the states. So there started the slowing that happened, and then just a couple of months into July, you can see a lot of green going away, and the red, which is what we don't want to see, which is drops in state output. And Oregon has switched from a dark green to a light green. Washington was light green. Now they're no change. So a general push, in a very short period of time now, we're just talking about 3 months, of going from all states almost having some sort of growth to now slowing down. And a lot of this is because of the things that Professor Ito described that's sort of impinging on these headwinds against the U.S. economy. Now, I'm describing all this for the U.S. economy, and I'm going to rapidly go into Oregon here, but you take a look at the data, and Oregon follows the U.S. business cycle. And it's been a fact. Oregon has never missed a U.S. recession. It's also never missed a U.S. recovery. So, although we're really independent people here, bottle bill law, everything else that we started, but even that, we have to be aware that the way the U.S. economy goes, generally we're going to go in the same direction. Maybe not exactly step to step. We tend to fall a little bit deeper in recessions. We tend to grow a little faster in recoveries, but we match it up pretty closely. I've got to show that I'm an economist, so I have to have at least one chart that nobody can understand. And this is my chart. What this is looking at employment changes for the various recessions in the U.S. And it starts off where the employment peaked, and then drops in employment through the recession, and then as the lines come back up to go back to where it first started at, that horizontal line, then it goes back to the same employment that occurred just before the recession hit. And down below it says, well, how long does that take? And you can see that down here on the bottom, the number of months, the U.S. recession started December of 2007. We had drops of employment down into 2009, part of 2010. We started to come up. We had a little slow patch in 2010. We've got another one in 2011. And the dashed line is just a forecast of what possibly may occur. But that goes out to about 80 months. So those of you that can divide 80 by 12, you get about what? Six and a half years, 6 years, 6.5, just to get back to the same level of employment. So what we're looking at the end of 2007, we should have the same level of employment sometime in 2014. And that's a pretty sad state of affairs. But this is what happens after major financial crises. It generally takes a very long time to come out of these things. Now, the U.S. economy will be subdued in terms of its growth. A couple of items here. Definitely this expansion is very slow by historical standards. But if you match up all the financial crises that have occurred in the world, we're sort of in the pack. And this is not unusual in terms of a slow expansion following a financial crisis. Home prices are still falling throughout the country. Job growth should start to do a little bit better as we go on. We have commodity prices are coming down. That's going to give us more money into households' budgets, which hopefully will help out a little bit. Core inflation, it's going down. Part of the reason it's going down is we get these commodity prices finally coming down. They peaked in the second quarter of this year, but they're coming down for the reasons we don't like. We're coming down because we're having a slowing economy. But it's one of the aspects that actually helps you to sort of hit the reset button and try to then get it back into a growth path. The Federal Reserve isn't expected to raise interest rates until mid-2013. Some people think it's not going to be until early 2014. Of course, it's very difficult to lower interest rates below 0% when they're just about there now. The one thing that's kept things going is business equipment. It's been the durable manufacturing in the U.S. and exports. The U.S. dollar has really depreciated against the emerging economies, but as Professor Ito emphasized, it does appreciate, and when things are bad in the Eurozone, there's a flight to safety, and they demand more U.S. dollars, and that value goes up. So we'll talk a little bit about that, as what possibly is the implications of that for the Oregon economy. All right, some of the risks, I'm not going to go through these. We've sort of touched on all of them, but the ones to mention, this European sovereign debt issue, there's four sort of main ramifications that also can be into Oregon. You can get financial tightening of credit, which would be bad. Exports get hurt coming out of the Eurozone. And we also have, getting to my notes, also U.S. firms, the profits that they make over in Europe and they bring back to the U.S., those also can be hurt, and that in turn will hurt us. But let me just go through these and just notice that the one that we're going to be most concerned about is the Chinese economy, because we have a very strong connection with that with Oregon. And then also state and local governments are going to be the other area. So there is upside. Now I say natural disaster in Japan now is an upside. It's also a downside in the top part. And that's because on the top side, as Professor Ito mentioned, there's the nuclear waste problem, and we don't know the ramifications of that possible cleaning up. But then there's also the rebuilding phase. And in the rebuilding phase, Japan's going to need all sorts of equipment, expertise, consulting, wood, for example, and that should help our exports. Then the financial markets may return more quickly, but of course, if the European debt situation hurts and the contagion happens, there can be a connection back to U.S. banks, and they may tighten up credit. Greater business optimism and more robust global growth. So with that in mind, let's turn to Oregon. Some of the recent Oregon facts. 9.6% unemployment rate. We're generally about 1 full percentage point above the U.S. economy. And we've narrowed that a little bit. And that generally happens in recovery periods. But still, unacceptably too high. But it has come down from a high of 11.6%. We have the 16th fastest job growth of any state. That's come down a little bit. We were in the top 10 just a few months ago. Once again, this is indicative. Oregon has generally a more volatile economy. We do better in recoveries. Non-farm employment increased 1.4%. That's pretty anemic. In generally recovery periods, we usually run upper 2%, low 3% range. But just like the U.S., we're having a slow recovery. Now, also notice that the private sector is up 33,500 jobs, where total non-farm employment is only up 27,200 jobs. And the difference is because we have a drop in state and local employment. And that's a theme I'm going to turn back to. Personal income is up, but not as high as we usually see. The big jump in the first quarter is because we dropped 2% in Social Security taxes. That put more money into personal income. And then exports are up 18.6% year-to-date 2010. I'm sorry, 18.6% year over year. And this year they're already up 5.8%. Still a little slower, but still in that good direction, positive. And it really is for the same reasons that Professor Ito mentioned. Now, since you learned that one graph chart, this is the same chart for Oregon. And notice the blue line on the bottom is the early 1980s. And you've heard that this recession we've been through, called the Great Recession for the United States. Well, the Great Recession for Oregon was the early 1980s in terms of percentages. Much worse than what we're seeing right now. But this, not to belittle this and the hurt that's happening to people right now. But this is a very bad recession, and notice we're also looking at about 80 months, somewhere around 2014, just to get back to the same level of employment that we had at the beginning of 2008. Exports. This is our bright story. It has done fairly well. And a lot of this is due to the exchange rate going down, and also who we export to. The big gorilla here is computer electronic products, is the blue line in the left-hand chart. You can see that that's come down a little bit. The chart on the left shows the red line. If you take out those computer electronics, a lot of the other ones are actually going up even faster. The agricultural, chemical products, machinery, transportation equipment. So actually exports have done fairly well, and that's what's kind of held us up so far. And that's probably why we have that private sector still positive growth. Somewhat anemic, but still pretty good. This is Oregon exports to the APEC member countries. Our predominance is with the Pacific Rim. And so if you take a look, the top 6 destinations across all destinations for Oregon exports is 68.5% of the value of all our exports. And so our exposure to the European crisis in terms of how the transmission works through exchange rates and works through exports is not as big a deal for us as it is for other places that would not have as much of a concentration. So, now, is there still a problem? Well, China does about 20% of its exports to the Eurozone. And if the Eurozone stops importing from China, that in turn could hurt the Chinese economy, and that's our #1 export destination, could in turn hurt us. But I think overall, our exposure is not as bad as other regions of the United States to the European debt. All right, nice pictures here. Lots of pretty bubbles. What I'm doing here is comparing one expansion period in terms of employment with another period. And I'll just step away here for a second. So here, this is the big expansion in the 1990s. This is the expansion right here that happened after the 2001 recession. So this goes from job growth in July 2003 to when it started to drop, which was February 2008, and then the big recession hit. And if I'm right on this line, then the growth in these employment sectors are about the same in both expansion periods. You can see that professional business services a little less in the expansion period in the mid-2000s compared to the big expansion period in the 1990s. Retail about the same, leisure and hospitality up, but look at the big one, construction. And it's huge in terms of its growth, and that's because of the housing boom that happened. So that really brought us up quite strongly. Durable manufacturing is not growing as much, and part of this is because the high-tech sector really realized that they overbuilt, they've had too many people back in 2000, and when the expansion started to happen again, they were much more cautious in terms of hiring. So, but everyone else is pretty much on the line in terms of the expansion in these employment sectors are about the same they were in the 1990s. Now what I want to do is then switch the axes and look at our present expansion period on the vertical and what was the expansion in the mid-2000s. Now, construction, way down. It's not expanding at all like it did, of course, in the boom period for the housing. Local government is down because we had a huge drop in terms of revenues coming into local governments. You can see finance is also lower. Notice that durable manufacturing is a little above the line, and that's what's kind of holding us up. Leisure and hospitality was strong before, it's also strong at the time, and retail just a little bit. And health services, about the same as it was. Notice state government is a little above the line. You know, so what's this problem? We haven't heard about state budgets, and, you know, shouldn't they be cutting people? Well, the state item there that has gone up in employment is state education. Enrollment in colleges and universities is counter-cyclical to the business cycle. So when we get into recession, the opportunity cost, you know, in your economics, 2008, 201 here, the opportunity cost drops of going to school because of the other opportunities, and enrollment really rises at the colleges. So if we took out the state education, we actually would see that state employment start to come down a bit. But the part here is, you know, okay, where do we have the growth? Where do we have the areas that are going to bump us up out of this, you know, we're coming out of recession, very, very mild, anemic recovery. But the traditional places, housing, even government trying to help things up, are not there. Now, what this looks, it looks comparisons at average employment in Oregon over past recovery periods and what we're having now. You can see that the total non-farm, the red, what we're doing right now for the last year, August 10 to August 2011, much slower than the typical expansion period. But private, excluding housing, is about the same. Not much difference. And so the two big drags on us right now are the housing related. You can see that barely that bump up in red, where usually is a contributor to the expansion period. And then it's definitely the public, which is generally a contributor, it being a huge drop. And so it's really the housing sector and it's government that is dragging this economy and not allowing that expansion to go. And it's the consequences of all the problems that we've had. This just highlights, in terms of the state, Portland, SMA, Portland, Vancouver, and Hillsborough, and then just Multnomah County. And you can see in each of these, it's the government sector that's the one that's been dropping. The private has been going up. Now, don't look too hard at the Portland, Vancouver, Hillsborough one because it's slightly wrong because they changed the definition. Hillsborough beat out Beaverton in terms of population. And so they changed the name, they changed a little bit of the area of what they count. So the numbers are slightly off. But otherwise, I think it still speaks to the same idea. So, no strong bounce back. And if anything, possibly we're going to have slower growth coming into the future. And the reasons here, one is that our exposure to the European debt crisis, yes, here in Oregon we do have exposure, but I don't think it's as bad as it is in other parts of the country that have a much stronger connection to the Eurozone countries. But in terms of the financial aspects, if that contagion happens and our financial system tightens up credit, that will be tighter credit across the U.S. It'll hurt us too, and that holds back, once again, the housing market. So, and then also, if you have slower growth, you don't have the revenues coming back to state and local governments. And as those budgets are reduced, they also then will be very tight and not hiring and possibly letting more people go. But, summing up, I think we are in recovery. I think we will get through this, but unfortunately, we're going to have to sit out a long wait before things grow very much. And also, do not kayak without a helmet.
In some ways, I'm going to take us smaller, down to the family and the individual, but then we'll come back up with alternative policy strategies, different kinds of things that we could be doing. You may have noticed, if you've been reading the paper, that there's been quite a spate of poverty-related articles. We have just released the most recent poverty reports. The data on poverty from 2010 is finally analyzed. They get it in March of 11, and they finally bring it all out in September. So then we got the chance to see what's going on with poverty in this country, and we're setting some records in terms of poverty in this country in connection with this recession. The New York Times reported we have a record number of people in poverty. We're bigger than we've been historically, but we've got 46.2 million of people living in households with incomes below the poverty line. This is the biggest number of people in this situation since the Bureau has been publishing those figures. Median household income at the bottom has fallen by 12% from the peak 12 years ago. Let me say right now, I meant to say at the beginning, although we are seeing the kind of impact on poverty and unemployment from this recession, of course it's happening in a context of longer-term trends. Some of those longer-term trends have been really a very marked increase in inequality in this country, with a concentration of wealth at the very top. So over the past several decades, we've seen really quite a bit of progress, concentrated in the top 1%, also very visible in the top 5%, stagnation practically below that in terms of below the 90th percentile, and bumping along the bottom for the bottom 10%. You can see then you add recession to this already challenging situation, and we have this sort of impact on poverty, this kind of impact on, is this a laser? Excuse me, I don't get one very often. This kind of impact on median income coming down, and with the sharpest impact on median income hitting young people. People who are coming out of high school, people who are coming out of college into this sort of an economy are not finding work. There are high unemployment rates, and their earnings, which were already falling over the longer-term trend, are falling further than anybody else's. So young people are bearing the brunt here. Child poverty, we have the highest number of children in the country below, and living in households below the poverty line since 1962. Now, we're always sort of super performers in child poverty in the United States. We have very weak institutions and social policies for keeping kids out of poverty. We've got, look at this figure, we've got 22% of kids in this country living in families with incomes below the poverty line. There's not another wealthy country that comes close to this, and we were not much lower in the best of times. We are so far out and ahead, both in terms of child poverty. The Scandinavian countries set the pace here, and their child poverty rates are something closer to 3, 4, 5%. So you can see what's achievable, but we're not there. We're at the other end. And you see also the impact here of what's going on, the longer-term trend. Median annual income for a man working full-time has not changed in purchasing power from 1973 until now. Really, in terms of what guys on average are earning, the last 40 years have been completely stagnant. We've lost some of that to this recession, but not all. Now, I've got the same picture as Tom. What a great picture. To see the depth of this recession compared to previous recession, I'm kind of happy to hear that, at least for Oregon, it's not quite as bad as the nation. But you can see for the nation compared to our recent recessions that this is much deeper. Just as Tom was saying, it cost us much more in terms of employment, and it looks like it's going to take us much longer to recover. I won't belabor it since you got to hear about it from our state economist, so that's pretty good. But I will show you one point. And that is what it has meant. Because this recession is going on so long, we have a huge number of people unemployed over a long period. This spike that you can see is, is an increase in the number of people who have been, of the unemployed, who have been unemployed 6 months or longer. And it just is giant for this recession. This is why there are all these fights in Congress over extending unemployment benefits and that kind of thing. We've got far more people who are in the position of needing them than we have in the past. Now, this recession got described by a lot of people as it's a he-cession, it's a man-cession. Men are out of work, women are taking over the economy, what are guys going to do anymore? But that really was an artifact of the way the business cycle works. The first people hit by unemployment, at least in an economy like this one, are the people who work in construction and heavy manufacturing. That's men. Those are the most volatile jobs in the business cycle. And you can see I've got jobs, loss of jobs by sex, men on top and women on the bottom, that the drop for men was very dramatic and it came first. The drop for women came second. As Tom was mentioning just recently, the sort of second phase of the recession is when it hits the public sector, as tax revenues have fallen. The public sector is very heavily female-dominated. If you think about what those professions are, teachers, social workers, librarians, everybody like that, and then just clerical workers. So, as Tom was saying, the private sector has started to recover. You see that with men coming back up here in terms of their employment. I imagine that's durable manufacturing. And then women are not there yet. They're not there yet. Now, what that means is, when you put some of these things together, is that this economic crisis has been particularly hard on children. It's been particularly hard on young workers, young families. It's been very hard on single mother households. Poverty rates among people 65 and over. And they used to be the highest in the country. But they fell dramatically when we indexed Social Security to inflation. That's what happened there. And they kept Social Security payments up so that households stayed above the poverty line. So that now, you can see older people have the lowest poverty rate in the country. Whereas who has the highest rates of poverty? It's the youngest children. The youngest children, this under 6 is the top line. So it's true in good and bad years. And now, I didn't quite get the numbers, but over 24% was the figure here in 2009. That's because kids, young people have kids, and single mothers have kids, and those groups are hit hard. Hardship in single mother families I want to hit on just a little bit more because they've been so affected by the other long-term trend, which is really the dismantlement of our social safety net, which was never a strong one, and we made some big changes to it through the 90s, so that now single mothers have less support, and you can see it in terms of their unemployment rates and poverty rates. So unemployment of single mothers is now double that of married fathers. So if you think about people who have responsibility for supporting a household, single mothers are hit hard by unemployment. Their poverty rates were 43% in 2009. One person doing everything. And then, as I say, the social safety net is no longer really there. So only 2/3 of the single mothers whose households were in poverty received food stamps in 2010. Only a quarter got TANF. TANF is what we call welfare. It used to be AFDC. We reorganized that. People don't get it. So what we saw was, and you head into a recession, it was one thing to reform TANF in the 90s when employment rates were high. When employment falls, then we're in trouble. Then you have the test of the system. Now, the single mother poverty rate in the U.S., like the child poverty rate, is very high compared to other wealthy nations. And that's directly as a result of our policy. We don't have the kind of support, either family policy or poverty policy, that other countries have. I had mentioned that the recession hits hard on young people, it hits hard on the ethnic minority communities, and it hits hard on people with less education. So I went to pull some of the unemployment figures just to back that point up. What you can see, I'm so mad about this. I reformatted this slide 3 times and I've still lost all my beautiful decimal points. They've moved. Fine. Okay, oops. Here. But what I want to show you especially is, these are male unemployment rates. White men, 7.7. See, it's not that different anymore from women. Women have caught up. Teens, though, 16 to 19, 21.3. Those aren't kids sitting on the couch playing soccer. Those are 16 to 19-year-olds who are actively looking for work. 1/5 of them, white kids, can't find work. 44% of black kids who are looking for work are unemployed, and 27% of Latinos. You can wonder a little bit about the Latino figures. Latinos aren't as well captured in our statistics, partly because of the proportion of people who are undocumented. So read that one with a little bit more grain of salt.
But these are the results that you see, and you can see that, you know, very high poverty rate, unemployment rates in the Black community and higher among the Latino. And then, these used to be all beautifully lined up, but you can see the unemployment rates and how more education reduces unemployment. So less than high school, 14%, down to 4.2 for college graduates. Now, the thing about the crisis, of course, is although we talk a lot about unemployment in particular, that's not the only way that it affects people. There are multiple impacts on families and households. Jobs is one thing. That's what we're hearing in the conversation, jobs, jobs, jobs. And unemployment drives a lot of these others, but it also means incomes are down, people's hours are down, how many hours can you work, what can you earn, both now and in the future. People who are unemployed for a period, the way this cohort is now, economists talk about them being scarred, kind of brutal language, but it means your earnings don't recover, your lifetime earnings don't come back, you're scarred by a period of unemployment such as people are experiencing now. The other kind of thing, of course, people are having difficulties with housing, foreclosure rates and evictions. Maybe you saw the Oregonian yesterday, our foreclosure rates have just hit a high here in Portland. We're up at something like 2.3% of household sales are foreclosure. The other thing that happens is cuts in public services, cuts in education, cuts in after-school programs. It's hard to get credit. It's been hard, I'm sure you've been reading the paper, it's been hard to get mortgage modifications even. Loss of health insurance as people lose their jobs, and loss of household wealth. Some of these loss of household wealth figures are pretty stunning. The Pew Research Center recently brought out their, what they call a wealth gap analysis. They were looking at 4 years from 2005 to 2009. Wealth is hard to study. There are very few data sets that well capture wealth, and it's one reason we're always talking about income. It's not easy to do, but what they showed was the tremendous fall in the net worth of households with a big impact by race, which speaks to some of the targeting of predatory loans and these, really bad mortgages in minority and low-income communities. So people bought houses that then they have lost. Falling home values, and as primarily the driver of this loss in net worth, is enormous. And so that we are now at the point where in 2009, the median net worth of white households had dropped 16%, but it was still over $100,000. The median net worth of Latino households had dropped 2/3, 66%, and it's at $6,000. And of Black households had fallen by more than half, and is here just under $6,000. So it's been a very destructive recession. Now, of course, economists are always, we're talking about wealth, we're talking about income, we're talking about unemployment, some of these kinds of things, but there's very clear research that ties unemployment and poverty to the full range of social ills. Everything that you can think of: hunger, homelessness, domestic violence, depression and suicide, poor health care, substance abuse, poor school performance by children, weaker performance even of college students, and debt issues. So the social cost of this recession has been tremendous. Which leads us to what should we do about it? There are policy alternatives from this point. I am nervous, as Professor Ito is, about the gridlock in Washington. I guess we are turning Japanese. Everybody is calling for more stimulus spending. The Economist magazine is calling for more stimulus spending. These people are no fans of government spending. When the Economist magazine is calling for more stimulus spending, it's a good idea. We should do it. It has to be sized to fit the whole of the GDP. This was the problem with the stimulus in 2009. It was not big enough, and that's what economists were saying at the time. We get presented as a group of people who cannot agree on anything. There was agreement. This stimulus is half the size it should be. The hole in GDP right now, according to the IMF, is about 5.6%. That's big. You need to spend a bunch of money to make a dent there. It's the reason that people can argue about whether a too small stimulus had an effect. Yeah, it had an effect, but it's hard to see because it stopped the fall, but it didn't fill the hole back up. Okay? The stimulus also needs to be better designed and targeted. It needs to be targeted where it will have the biggest impact on jobs, poverty reduction, and future productivity. If you're going to do a big bunch of public spending, you want the best value you can get for it. I was telling my class today, I was at the American Economic Association in 2009 in January, right after the just bottom fell out of everything. The only thing people were talking about, I heard the biggest name economists, what is the biggest bang for the buck we can get in our stimulus spending? Where is the biggest social value? That's what you want to know. We have to spend some money. Where should we spend it? Now, I say also there's not that much unclarity about where that benefit comes from. So I can cite for you Mark Zandi from Moody's.com. He was John McCain's economic advisor when he was running for president. He testified to Congress about what are the kind of impacts, what sort of bang for the buck will you get if you put your stimulus into different forms. And what he pointed out was, the decimal point, was the biggest, best thing you can do is temporary increase in food stamps. People will spend that money tomorrow. That keeps grocers in business and money in the community. The next best thing you can do, extend unemployment insurance. This is sort of, if you spend $1 on food stamps, you get $1.73 in terms of GDP. If you spend $1 on unemployment insurance, you get $1.64, was what Sandy was saying. Build infrastructure. It's a good idea. Not only do we have infrastructure, it has a big impact on the economy. General aid to state governments, big impact. He had a whole big long list. You can go see his testimony. The kinds of things which very little impact, they cost as much as these other things, but you don't get much for them. Spend $1 on cutting the corporate tax rate, get 30 cents. Spend $1 on accelerated depreciation of capital, you get 27 cents. Not the way to target your stimulus spending. Okay? Now, as I say, they cost just as much, they hit the federal debt just as hard, but it makes a big difference in the way that you spend it. I was speaking with a colleague who studies Latin America, who told me, have a look at Brazil and Argentina. They've practically evaded the global recession by very targeted stimulus spending, among other things. Okay, the other thing I want to talk to you about, why is this not on the table as a labor economist? Jobs programs, public employment. This is the big thing nobody is mentioning. These had a huge impact during the Great Depression. We know how to do them. And the posters that I've got for you here are, one is the WPA, that put a lot of grown-ups to work on all kinds of projects. The National Youth Administration put kids to work and also trained them. And then, of course, the Civilian Conservation Corps put people to work 18 to 25 out there building trails and all kinds of things. Good for them anyway, they should do it. Why don't we have this? Why are we not talking about this? This is the thing we can start with first. Other kinds of things that we might be thinking about, public banking options. You know, those banks that were too big to fail, we have guaranteed them. We have bailed them out with public money. They're our banks. They were our banks. We could regulate them and talk about what priorities they should be pursuing. There is the possibility of working with publicly owned banks. There are a big proportion of the banks in Germany are publicly owned. It makes a difference in terms of what kind of risks they take, what sorts of loans they make, what kind of projects they're interested in. Financial re-regulation, we have to do it. You know, most of what they have done in terms of financial re-regulation has not taken effect. They are still arguing about it. We will be lucky to see much at all come out of there, and then we just wait for the next crisis. I think we ought to be talking about debt forgiveness and restructuring, and if you think I'm wild-eyed to be talking about this, Martin Feldstein has an op-ed in New York Times. Martin Feldstein was, who was he, Reagan's advisor? And now he's saying, sorry, you're just going to have to forgive a lot of this mortgage debt. You don't like it, but guess what? It's the only way forward. And the last thing, I want to join in with Professor Ito about this conversation about reducing the federal debt right this minute. That's nuts. That's nuts. We can talk about that in a few years once we've moved forward. Fine, that's a good time to talk about it. But right now, no. Right now, if we don't spend money, we are going to be in bigger debt later. Because if people are unemployed, they don't pay taxes. So I'll stop here. Thanks.
We have a microphone that's going around, and now that we've thoroughly depressed all of you, if you have some questions to ask us, we have a gentleman in the middle aisle there has a microphone.
Thank you for being here today. The question, I had a few questions. Okay, I'm an amateur economist of late, and my life has been impacted with the economy. It's scaled up because my vested educational interest was healthcare. I'm unemployed. I feel like a poster child, so I'm trying to learn. Thank you again for being here. My question arose as far as the EU-Euro market. I have heard that when they came into organize themselves, that they really did not make good enough structure or walls, or else they wouldn't have had the Greece issues come up. And I was wondering if you could reference or tell me what those things mean, what they may have done in their consolidation of the those nations' currency to avoid this imbalance, I guess you would call it. And the other thing I had a question for, give me a moment. Do you think it's possible to sustain the index Social Security links to inflation, given where we're standing now in our own economy, and the historical trends would suggest that this is going to really rub us burn us out kind of phenomenon? Thank you.
About the question of about the European situation, I think that the way I take the question is the European countries or other countries put some kind of firewalls to prevent the spread of the crisis on other parts of the world. Well, I think what we have to be concerned about is the possibility of contagion. And contagion is a really difficult issue to deal with because sometimes contagion happens with reason. For example, what happened to Ireland and Portugal, these economies had weaknesses in their economic systems. But what about the contagion to Italy? What about the contagion to France? As far as I know, Italian and French economic situation is not that bad. Actually, in terms of the budget deficit, Italy is supposed to have what we call primary budget surplus, meaning that refers to the budget balance before paying interest payment for the debt. So that means that the economic fundamentals, that's what we say, of the Italian economy aren't that bad. But still, we have to worry about the possibility of contagion. So what that means is that all the information flying around in financial markets can really spread contagion. But what we can do is to calm it down. But the way to calm it down is just to provide how solid the economic situation is. So probably one way of putting a firewall against contagion is to disclose the information, and the government needs to do a lot of PR about how solid their economic system is. And to make it sound more real, probably the government needs to come up with some actual policy options. And I think that is also applicable to the case of the United States. I said, so they marry, short-term austerity plans are really dangerous. But at the same time, the U.S. needs to provide some kind of plans for the medium run so that the country is able to show its willingness to pay off or to reduce the amount of the national debt. So I think that kind of PR with some solid economic data as well as solid policy options is what's really necessary.
I'd be happy to speak to the Social Security. Do you hear me? There's too much pessimism about Social Security out there, and let me just give you 3 things to think about along those lines. The first is, the way that we currently pay for Social Security through the payroll tax is capped. We only tax people up to a certain point. I think right now it's something like the first $106,000 of earnings are taxed for Social Security. You can be through with any Social Security issue you care to name by raising that cap. We could do that tomorrow. The other thing to think about is that the forecasts for the future of Social Security are done extremely cautiously. If you go in and look at what they assume about economic growth in the future, it's remarkably low. We have not had growth that low over a period that they're talking about ever. So why we would plan as if we're going to inch along in the future far more slowly than we ever have in the past is beyond me. The third reason I would just suggest to you is think about the way productivity has expanded historically. Each person working in an hour right now produces far more value than somebody did even 10 years ago, even 20 years ago, never mind 50 years ago. And it means although young people will have to support older people in the future, we hope they're going to be much more productive. So it changes the sort of equation when you think about what do we have now, what will we have then, and how will we support this kind of thing. It's a mistake to think nothing will change or we won't grow.
Hi, I'm in Professor King's class, and I'm part of the Occupy Portland movement and the Occupy Wall Street movement. And I just had a couple questions, mainly for Professor King, I think, I'm sorry. But recently marching and talking to people of all different classes and all different public affiliations during the march, education was a huge issue. I had a sign saying, I'm going into debt to be employed enough to have jobs that don't exist. And I want to know what we should be asking our legislators and representatives from an economic or macro standpoint to do for us now, so that when we leave college, we have a better chance of becoming productive citizens who are not mired in debt and who are able to get jobs that pay us what we're worth. And then secondly, I'd like to ask, as macroeconomics professors, what you think of this total bullshit about socialism and the Tea Party being very anti-socialist and what that means. Does socialism really, is it such a bad thing when it comes to economic policy?
Let me start with the easy one on student debt. I think there's a lot to be done about student debt. There are models in other countries for forgiveness of student debt. Students are right now locked in to an appalling debt situation that was created by our legislature. One being the idea that you have to start to pay a month after you graduate. The other, the idea that student debt cannot be got rid of through bankruptcy like other debt. The other, that, loan payments should be indexed to inflation so that unlike other debtors who get to pay back with dollars that are worthless and dollars
all those things can be changed. They're just laws. And there are models out there in other countries of forgiveness of student debt for all kinds of situations, including just, it's been 5 years, we're done. So I think there's a lot to look at in terms of student debt policy. Things can be changed in terms of, will there be jobs? That's stimulus. I mean, that's trying to boost the economy back on track more quickly. My colleagues have, a lot of knowledge in those areas. And then is socialism so bad? A lot of what gets called socialism is capitalism with a bigger state that takes off the edge. If you look at what Northern Europe is, they're not socialist in the sense of, are they a planned economy? But they have a bigger role for the state to deal with poverty, unemployment, and that kind of thing. I'll leave it there.
Is there amnesty? Is there amnesty on student loans?
Amnesty for student loans?
Yeah, I heard it at some point. It used to be 25 years, it was down to 20 years.
Well, in different countries, there are some that forgive it at 5 years. There's some that forgive it if you get a 3.5 average. There's some that, there are a lot of different ways to forgive student loans, but I think we absolutely ought to be getting our young people out from under this debt burden.
I was just, I don't want to get into the personal details, but, the education and yelling that the jobs that don't exist has happened to me. And I can give you all kinds of evidence in public policy that implemented that, as well as my own experience actively. I wasn't the sharpest pencil. Nonetheless, I was just wondering if that existed after 20 years or so.
You have to leave now.
Maybe Occupy Portland will go get it out of the Congress.
Okay, I thought there was some kind of, thing every 20 years.
Professor Gallup has an answer for that, I think.
No, that's
Oh, yeah. Oh, too bad.
you want to?
Sorry.
Oh, you all said, or? You finished.
No, I was just wondering if there's, students who go to debt, and it's the only debt I've ever had that I have to make them pay, although I am employed remarkably so. And I just thought that was very,
Uncomfortable.
very, I couldn't help but linking into her question, if amnesty exists, and I thought about the lower that. I don't want to prove the negative, okay? That just is a little bit revolting.
There's something to look into there. I think you're right. I think there is a point at which it can be waived or forgiven, but I don't know the details.
Something that seems particularly strange these recent years is the disconnect between the way economists talk about the economic problems and the way the media talks about them. And there's a lot of discussion in the media of how it's unclear whether stimulus actually will get you out of recession, that Keynesianism, which is our basic understanding of how recessions work, is a theory that may not be well accepted, although we really don't have any alternative theory in economics. There is proposed, mostly by politicians, this notion that the problems with our recession right now are not due to a lack of aggregate demand, not due to a lack of purchasing power on the part of households that are out of work and lower incomes, but instead it's because of uncertainty about future regulations and fear by business that if they invest with a Democratic administration, that they're going to be suffocated by the government, and that's why we haven't recovered. And I just wondered if you could assess the validity in your view of those alternative explanations for what's happened.
Yeah, I would say the media and a lot of other people that have felt that the stimulus packages were actually harmful to the U.S. economy are confusing causation with cause and effect. And all they see is a correlation. There was a recession, they put stimulus packages together, They also needed to reform the financial system to try to put some safeguards on, and the recession got deeper. And thus, it makes sense that these are the things that made the recession worse. As opposed that the recession most likely would have gone into a depression if it wasn't for some of these rescue packages. It just went down very deep, and it would have been worse. So I think that view is, and it's very simplified, it can be very popular. If the stimulus packages cause the downturn, well then you get rid of the stimulus packages and then things will be better. What does that also mean? Well, if I'm having the stimulus packages, am I going to be taxed more in the future? If I didn't have the stimulus packages, I won't be taxed more in the future. That means more money in my pocket and I can spend it, and then the economy would be off and roaring. So I think it's this sort of illogical kind of steps where you start from a first false premise that stimulus packages were bad for the economy, and then you move from there through a whole set of logical steps. It's a nice package, it sells well in the media, it sells well in the public, but I think from the economist's viewpoint, that would be rather disastrous. And I think, as Professor Ito mentioned, if we look over towards Japan, we can see what happens when you cannot come together to decide what direction the economy should go into.
Not as if there's not evidence. I mean, it's not as if there's not evidence on these points. It's not as if there's not evidence on these points. And so that's a point of view that's informed more by an agenda than by social science.
And also, I think, as an economic policy, it's important to fill the lost demand to stimulate the economy. But as Mary talked about, I think it has to be done in a way to improve the productivity level of American public in the future. So, can we improve productivity in 2 days, even 2 months, or even 2 years? So even the government emphasizes on demand-related policies, the result may not appear in the short run. But actually, we have to spend the money in the way the result won't appear in the short run either. Because our purpose is how to improve the productivity level of the American general public. It's not like keep digging holes and putting money in and keep reading again and so forth. We have to do something to improve our productivity level, but that can take a while. Therefore, because of the time gap, it looks like we are just wasting money, and by having government policies, we are just exacerbating the problem. That's how it works.
Oregon, along with a number of other states and agencies, have been touting investments in high technology, indicating that there are excellent jobs in that area, and those are areas for growth. The question is, has that really come true so far? Are the investments in these industries, in these fields like biotechnology, nanotechnology, etc., paying off the investments that have been made in them, or is it too soon to say?
Well, I think that Oregon's experience is mixed, like I think most states are. We had the Strategic Investment Program in the 1990s, and we had a great expansion of Intel, for example, and all the supply chain companies that go along with that. I would say the biotech, a very difficult market to break into. Areas like in Boston and even San Diego is maybe one of the newer ones. Very difficult, and huge amounts of investments have to be made, and it's very risky. And so I think our venture into that in our area has been a mixed outcome. But one thing we've seen, and is always hard to ascertain, is a tax incentive by itself won't bring a company in. If that was true, Wyoming should have all sorts of companies all over the place, but they don't. You have to have the right the public infrastructure. You have to have the labor force availability. You have to have energy supplies that are reliable. These are the things that really brought in, I think, the high tech into our area. And the tax breaks and credits were frosting on the cake. They weren't the cake, without those other things there. That being said, it's always a tricky slope to go down because, companies they pick the regions that they know they want to locate because of these other items I mentioned, and then can play one region off another in terms of tax breaks. And it's unfortunate. It's sort of like Nike. They have to have celebrity endorsers. They have to pay tons of money. If they don't, they're just not in the game. And the states have put themselves in the same kind of box too, in terms of competing for companies.
A microeconomics item is 7-Eleven selling pizza for $1 this month. Seems like it might help people to give that information out. And, I've listened to all the, media, I don't have NPR now, but I'm sort of out of energy. It's normal for young people to be unemployed. Like when you graduate from school, I was lucky it only took me 4 months to find a job after I graduated from college, but business community isn't saying, we gotta see about these people that are gonna graduate. They just go on like, what do we need you for? And they don't respect education. That's my experience. I've never had a job that a high school graduate couldn't have done. And, people have to be glad to have a job at all. Somebody will hire you eventually. It took me 27 years and 10 months to get 2 jobs at the same time. It's down to 1 now, but, it's kind of, you're lucky for what you get or something. Who's the person right back? Who's the person that I took the mic from?
I was curious about the Eurozone and how that limits macroeconomic policy, and I was wondering if there is any upside to that. Has it prevented some worse things during this recession, or does it only perform well when everything's going well? And I guess kind of in the back of my head was wondering if you could maybe speculate on Great Britain, whether staying out of that was a good idea in terms of this recession, or maybe it would have been better to be in it.
Well, the fact that we have, or they have the Euro system must mean there are some benefits to it. And actually there are a lot of benefits for the European countries, especially for the smaller economies. The reason why is because those small economies, they had a long history of having relatively higher rates of inflation. And if they had higher rates of inflation, that means that the borrowing cost was traditionally high for those economies, such as Greece, Ireland, Portugal, and so forth. But by becoming a Euro member, essentially it can use the credit rating of Germany, which has the highest, the best credit rating in that region. So all of a sudden, by becoming a Euro member, your credit history is just wiped out. And now you can use the German credit rating, and that made it much cheaper for those economies to borrow. So that's the benefit, and also the price of it. Because the borrowing cost was so low for those economies, and those economies kept borrowing from the rest of the world using German credit rating. And unfortunately, that led to the economic expansion in those economies, and that also created the Boston fall. So, it has both benefits and costs. But generally speaking, if the currency value becomes more stable, and that can make it easier for people to make investment in that economy. So in that sense, that's the reason why many developing countries still have fixed exchange rates with other currencies, mainly the US dollar. Then the same kind of crisis happened in 1992, and at that time, Great Britain was part of the Euro-like arrangement with other European countries, but because of that experience, they left that system, then staying away from that system, because they know having a fixed exchange rate really limits the macroeconomic policy choices.
Hello. So my question is directed at Dr. Potiowsky. I read an article by Michael Lewis saying that California is America's Greece. What does that mean under Nixon now?
Well, in terms of, well, let's a couple points here. California's legislative process makes our U.S. Congress look like they get along and they can really be consensus and do a lot. So that's one of their problems. The other is, unfortunately for them, and we're kind of reflective of it, their tax structure is highly dependent on very volatile sources of income. And because of the type of high incomes that are in California, capital gains income is very high as a proportion of their overall general fund revenues. And that is what pushes their revenues around like crazy. So anytime there's a drop in the stock market and so on, like we've had, their budget situation comes up short. And then they can't get their act together to decide what to do about it. And so they kind of just pass it along. They're bonding. They're trying stopgap measures. So getting more and more in debt without trying to go after the solution.
So follow up. What does that mean for us as Oregonians? Are they all going to move here?
Well, we still, even over the years, our biggest net migration is from California. But I really don't think, well, for example, I had guessed that, maybe one way out of California's problems is to join with other states. And maybe they could join with us because of the relationship. But I figured that wouldn't work because then a Californian would realize that they'd only be moving to California again, and they wouldn't go for it.
In the 1980s, there are several studies comparing the economy of California with those in Latin America. And the conclusion is that California looks very similar to Latin American economies back then. And but I think the main point in this kind of analysis is that Californian economic policy tends to be what we call pro-cyclical. So when the economy is not doing well, the government needs to restrict its spending and usually expensive reduction in tax revenues and so forth. So this kind of a situation can be worsened by the government behavior. But to a lot of extent, that is also shared by many other states in the United States as well, because I think 47 states also have the constitutional restraint on the balanced budget. So what that means is that when the economy is not doing well, most of the states will have to reduce their spending and then raise the taxes, which can exacerbate the situation in many parts of the United States. Then, of course, California also uses the US dollar. So that means it's part of the fixed exchange rate arrangement with the rest of the United States. So that means there's no monetary policy. Fiscal policy is quite limited. Then, yes, that's the reason why it's considered to be similar to Greece. But there's a big problem. The biggest difference is that Greece is in a group where other members are not willing to transfer their income. Okay? I mean, no matter how reluctant Germans are, they will pay something at the very end if the economic situation gets worse. However, we have the federal system. So that means that the federal system allows income transfer across different states. And that can put California in a better position than Greece. Okay. So the other side of the argument is that if the euro area really wants to become successful, that means they need to have a political integration, which takes a long, long time to happen.
Given the global scope and nature of this financial crisis, you would think that it would take a global coming together to resolve this issue, a global effort. Some of the actions that are taken by some developing countries or some well-off countries that have been well-off during this financial crisis seems to be going against that. An example of that is China being busy manipulating their currency to have a favorable balance of trade, or in the case of Germany, being unwilling to come to the rescue of some of these struggling countries in the Eurozone, like Portugal, of course, and Greece. So my question is, the actions that are pursued by these countries, is that counterproductive to the efforts of getting us out of this financial recession from a global perspective?
Could you rephrase your question?
Is it concerning, can there be a global coordination of policies, or are there policies that possibly we're doing here that are counter to what might be a global collaboration to help things out? Sorry?
Kind of, yes.
I think the main problem is that many of international organizations, their power structure is pretty much based on the geopolitics of the 1960s. So a good example is the IMF, which provides short-term loans to countries. And their policies are determined by votes, but votes are given based on the amount of contributions member countries make. But the quota given to small European countries is still really big. Then the quota given to fast-growing economies like China, India, Brazil, they really have limited influence on the decision making. So, and that's not just a problem of the IMF, I believe. Many other international organizations have the same issue. Too much power is given to small European countries, and too little power is given to emerging market economies and developing countries. So probably that's the starting point. So in that sense, probably the rise of G20 may not be such a bad idea. G7 cannot do anything anymore. G20, well, the problem of G20 is that as the membership expands, it becomes very difficult to make a consensus. But still, it may reflect wider variety of opinions among many other economic or political powers.
And you're still going to get the G20 doing the same thing the G7 did, which is say, you stimulate your economy. No, you stimulate your economy, and we'll sell to you. Coordination could be a good thing, but there's also a lot of, after you.
Isn't there some microeconomic policies that were awarded a Nobel Prize a few years back? I seem to remember that private parties were to donate $1,000 to someone in Africa cultivating, planting, harvesting, cultivating peanuts for a grinder, and now employs 5 more. And I thought, I'm not saying it should replace the IMF, that's a different scope. Isn't that like another kind of addressing this question? Maybe I'm wrong. I'm not so sure if who's addressing that quantitative easing right now. The only tools I know, again, I'm a novice. I'm not professionally disciplined. I have all the tools.
Yeah, you're bringing up really a range of issues, quantitative easing being the policy being followed by the U.S. Central Bank, Ben Bernanke, and the Federal Reserve, and I think you're alluding to microfinance, some of the issues of trying to get banking and loans out to the poorest in the world. Which,
Yeah, well, that was two separate takes of how globally they can share in development. Quantitative easing actually seems to have a negative, it's using our exorbitant privilege to some degree to bolster our economy at the expense of other international economies, so it could be polarizing. However, I don't know. I don't know. There hasn't been enough in the media or information I've read to know really what it was, and I was relying on some kind of tools that may be out there for development beside the actions.
my understanding was quantitative easing was desperation measures when you can't take the interest rate below zero, you try to think of other things to do. My colleagues might have a...
Well, quantitative easing is essentially to print money to buy up government bonds, and so that money will be injected even if the interest rate is stuck at zero. But at the same time, that also makes other countries very upset because the U.S. is essentially exporting cheap money to the rest of the world. But at the same time, the reality is that the size of the U.S. economy as a ratio to the world GDP is about 20%. So even if the U.S. is so concerned about itself and implements quantitative easing, it can still have impacts on the rest of the world because the size is so big. The second largest economy is the Chinese economy, but their contribution to the world economy is still somewhere around 8 to 9%, less than half of the United States. So America may look self-centered and domestic-oriented and so forth, but at the same time, the performance of the U.S. economy has such an impact on the rest of the world. That's the reality.
Thank you for addressing that.
Well, let's move on to the question. Back.
Hi. I was wondering if you would comment on the current legislation in Congress to counteract Chinese currency manipulation, whether you think it's good or bad.
Well, now the Congress is considering a bill to try to impose tariffs on Chinese goods if China doesn't stop manipulating the currency value. In terms of academic economic arguments, the extent of undervaluation varies from -5 to 50%. So that means that there's no consensus among the extent of undervaluation of the Chinese currency. But at the same time, it is true that China is rising so fast with rapidly growing exports, and maybe that is replacing American jobs with Chinese jobs and so forth. But I think the movement is very politically driven. And as of 1984, the Congress tried to do the exact same thing to Japan. Then this kind of a movement always arises whenever the U.S. economy experiences recession. So I personally don't buy that kind of argument because it's so politically driven. And also, we have to keep in mind that China is the biggest buyer of American debt as of now. So if China gets upset, and if China starts buying government debt, who's going to buy that? But probably people in Washington, D.C. know that. So they kind of play this undervaluation card wherever the camera is on. But whenever the camera is off, they may have even apologize to Chinese counterparts. I don't know. Because they got to do it, for political gains.
Well, the things that we have suggested here tonight to get us out of the recession, will they fix the causes of this recession too?
We have a habit of not learning very well from our mistakes. And I would not be surprised if another type of bubble comes up, whether it's, we thought for a while that it could be in the biomass area. financial system was allowed to run amok. And what you need is for market systems to work right. They are human inventions, and they need the right rules of the game to have the right benefits come from them. And so, to the extent that we can get the rules of the game right, and I don't know what is the right amount of regulation, and what is too much and too little, and where is it directed. But that's where we learn that we don't fall into these things again. But in saying that, the human imagination is the only constraint on financial markets. And what may come up in the future, to get around another piece of regulation is anyone's guess.
After the Great Depression, the U.S. government created a law called Glass-Steagall regulation. And the point of this regulation is to prevent banks from making the type of investment that led to soaring stock markets in the 1920s. So they put a lot of regulations on the financial industry in the aftermath of the Great Depression, or even in the middle of it. But that Glass-Steagall regulation got watered down over and over and over, and essentially it disappeared at the end of the 1990s. Why? Because the financial industry and also customers for the industry think that the regulation is just too costly. Okay, so it is us who created this Glass-Steagall regulation. It is also us who always want to remove that kind of regulation. So what I can imagine is that maybe re-regulation is what's going to happen in the financial industry. But 30 years from now, who knows? We may try to delete or diminish that kind of regulation. Then we may experience financial crisis again. Unfortunately, that's the part of our human behavior.
One issue I haven't seen you address is the extraordinary inefficiency of having governments do anything, and the great displacement that happens, whether it's giving energy contracts to the governor's girlfriend and company, whether it's these various fiascos we have with so-called renewable resources. Whether it's, we had an example here. We were all delayed 20 to 30 minutes because the audiovisual people, publicly paid, didn't have their act together. I mean, that's just a microcosm of extraordinary inefficiencies of government and displacement, which I don't think would happen in the private industry. Another issue, if I may ask too, is we talked about government stimulus as opposed to reducing the size of government, and also reducing government regulation to open up the free market.
To a great extent, we just had that experiment in terms of deregulation, and I think probably the pendulum is swinging back the other way. But I also think we're about to lose the room. I think we're booked in here at 6, and I think we're going to be interested in moving this along.
Just quick comments. One is, the inefficiencies of government, and I worked down at the state government for 11 years down in Salem. And one is state government is held to a higher degree of compliances, regulations than any private businesses. And actually it causes more cost, I think, because of that. In terms of inefficiencies, the government has no monopoly on inefficiencies. You can look through the Wall Street Journal, and at least once a week you will find a firm that has misused funds, antitrust laws, you name it. But I agree with you devices with absolutely no rules of the game, that's when concentration of power can happen and abuse of the market system. So there's market imperfections out there, and what we hope is that we don't put regulation on and shackle businesses where they can't use their entrepreneurial spirit and be able to grow that way. At the same time, we've got to be careful about the abuse of excessive power among companies. And where that sweet spot is a tough one to hit.